Pensions, the shadow ledger and the budget mirage. Pension mechanics that break balanced budgets. To understand Muni credit, follow the promises. Pension obligations sit ahead of almost everything else in practice, and often in law. They don't come due like a bond maturity. They seep into budgets through rising annual contributions that crowd out revenues that would otherwise fund services and debt. Here are the mechanics. The liability is valued using an assumed return, roughly 7% at many plans, which shrinks today's reported obligation. If that assumption is optimistic, the real obligation is larger than it looks. Plans smooth market losses over years and amortize unfunded liabilities over long horizons. That keeps this year's payment low while extending the pain, like paying the minimum on a credit card. On a cash basis, a city can claim a balanced budget. On an accrual basis, the pension promise grew with every paycheck and under-delivered return. Audited notes tell you the truth. Funded ratio, assets/liabilities. The 5-year record of paying 100% of the actuarially determined contribution, ADC. The discount rate sensitivity, a 1-point drop that blows a hole, is a red flag. An amortization policy, closed and shorter pays principle. Open and rolling punts it. Today's national context. Plans average about 81.4% funded. Issuers below roughly 70% are in the red flag zone. Legal and practical seniority matters. In several states, courts treat pension benefits as contractual rights that are hard to cut. Bonds, by contrast, are promises subject to appropriation and politics. Even without explicit legal ranking, the political economy pays pensions first. When pressure hits, who gets paid tells you the truth. Now the budget impact. When ADCs step up, after weak returns, actuarial changes, or payroll growth, the general fund must find cash, cut services, raise taxes, defer capital, or accept higher borrowing costs. Ratings language shifts to rising fixed costs and limited revenue flexibility. The next sale clears at a wider spread, adding interest expense to the same stressed budget. Maintenance slips, future infrastructure bills grow, the hidden liability behind the headline balance. Underassumed risk creates mirages elsewhere. Higher market rates can improve funded ratios mechanically by lowering the present value of liabilities, even if assets didn't improve, masking fragility. Alternative assets with lagged marks smooth volatility until they don't. When private values catch down to public reality, the ADC ratchets up on a delay. The squeeze compounds. Taxpayers resist hikes, some leave. Property values stagnate when services slip, softening the base. Sales taxes slow as households cut back. To preserve services, officials may underpay the ADC or issue pension obligation bonds, timing bets, not fixes. Research and ratings work show that underpaying ADCs and using long, open amortization schedules correlate with future stress. What matters to you is sequence and price. Prices gap down on outlook changes and headlines about contribution spikes. Liquidity thins, brokers widen bid-ask spreads. Funds meeting redemptions sell what they can, not what they should. You haven't missed a coupon, but your total return turns negative. The balance today illusion is common. Capital plans push expensive projects to out years at stale costs. Levy limits cap how fast revenue can rise even as fixed costs surge. Councils pivot to workarounds, special assessments, temporary public safety levies, higher base utility charges that don't count as taxes. Residents feel nickel and dimed. Infrastructure ages. Insurance shocks worsen it. Premiums rise in hazard corridors. Carriers retrench. Disposable income shrinks. Assessment appeals climb. And the same pension dollar consumes more of less. Your defense is discipline, not hope. Read the pension notes before the budget deck. Look for closed amortization, lowered discount rates, and 5-for-5 ADCs. Scan the sensitivity table. If a 1-point drop explodes liabilities, shade your risk darker. Check reserves against written policy and a history of replenishment after draws. Verify adaptation and maintenance are funded now, not stacked in year 4 and year 5. If assumptions and amortization choices borrow from tomorrow, treat the surplus as a mirage. The question isn't, will they default? It's, what will it cost everyone to avoid it? If the answer is more taxes, fewer services, delayed maintenance, pension math already overruled bond math. Score the pension first, price the bond second. Geographic risk, climate, insurance, and infrastructure shock. While pension math seeps through budgets, geography can flip the ledger in a single season. Climate shocks don't just wreck assets. They reshape operating budgets overnight. A storm surge floods streets. A wildfire jumps a ridge. A heat dome strains power and water systems. The bill arrives before FEMA paperwork is filed, and the clock starts on debt, overtime, and emergency repairs. Cities can defer pension pain. They can't negotiate with a washed-out bridge. Here are the stakes. Capital plans assume lifespans and steady upkeep. Climate compresses those timelines. A once-in-100-year flood now tests levees twice a decade. Each hit means overtime, debris removal, temporary shelters, and then the expensive part, rebuilding to higher standards. Bond-funded resilience stacks on existing debt, just as insurance premiums climb and tax bases wobble. You pay twice, once in portfolio marks, again in fees and levies on your bill. Action looks like this. A river city's spring crest overtops old berms. Roads heave, pumps fail, the water plant runs on backup generators. The emergency reserve covers the first weeks. FEMA reimbursement takes months and doesn't make everyone whole. The council accelerates a resilience bond, new pump stations, elevated substations, higher flood walls. Underwriters request a climate appendix. Rating analysts ask for updated flood maps, local cost share, and insurance assumptions. The sale clears at a concession. Debt load rises. Operating budgets inherit bigger maintenance lines. Meanwhile, insurers are retrenching. Premiums jump in wildfire and flood corridors. Some carriers leave zip codes entirely. State residual markets fill gaps at higher prices. Homeowners face renewal shocks. Landlords pass costs into rents. Assessment appeals climb. The property tax base slows just when adaptation needs cash. A few employers edge to higher. Ground. The city's map of who pays starts to shift away from its most vulnerable neighborhoods. Impact arrives in layers. A water authority's chemicals, energy, and pump replacements cost more. To protect coverage on revenue bonds, the board passes a base charge resilience increase. Ratepayers feel it monthly. The general fund leans on permits and fees to avoid state levy caps. Temporary disaster surcharges extend another year, then another. Spreads widen for issuers clustered in hazard maps. Not because default is imminent, but because the path to staying current is steeper. Here's the twist investors miss. Federal cost share isn't a blank check, and it often requires local dollars up front. If the issuer can't post its match, projects slip. Delayed adaptation compounds risk and cost. A substation that should be relocated gets sandbagged again. A coastal road that should be raised is patched after every king tide. Each stopgap raises operating costs and the odds of outage. While that's unfolding on coasts, wildfire belts face their own math. Extended drought dries fuels. A wind event turns a canyon into ignition. A rural district's volunteer force can't keep up. Mutual aid helps, but the rebuild is scattered and expensive. Insurance withdrawals hit lending. Mortgage originations slow without affordable coverage. Assessed values fall on damaged parcels and stall nearby. The district still owes pensions and retiree health care. It issues certificates for engines and station hardening. Investors demand stronger covenants, higher coupons, and clear risk maps. The deal sells. Ratepayers shoulder special assessments that don't expire with the smoke. Heat shows up differently. Peak demand strains grids. Water systems fight algal blooms and pipe bursts from ground movement. Cities add shade and cooling centers. Transit slows to protect equipment. The costs don't headline like a hurricane, but they accumulate. Power and water credits with true rate-setting autonomy handle it better. Boards vote mid-year adjustments. Coverage stays at or above about 1.5x through stress, and reserves replenish. General funds boxed in by levy limits juggle fees and service cuts. Disclosure quality separates names. Some issuers publish hazard overlays, climate-adjusted reserve targets, and funded projects tied to risk maps. Boston's recent bonds included detailed sea-level exposure and the climate-ready plan. Investors could trace dollars to defenses. Others recycle boilerplate. When the appendix is thin, spreads tell you the market doesn't trust the plan. Meanwhile, in high-risk corridors, premiums have climbed about 21% since 2015, and carriers have withdrawn from some wildfire and flood zones, pushing borrowers into pricier state backstops, pressure that flows into assessed values and sales taxes. What nobody priced early enough was the insurance shock spillover. As premiums rose roughly 21% nationally since 2015, and 20% to 40% in some hard-hit areas. Disposable income fell. Sales tax softened. Home sales slowed. New permits dropped, shrinking impact fees. Carriers reduced exposure or exited certain wildfire and flood zip codes, shifting borrowers to higher-cost residual markets. Cities issued more debt to bridge timing gaps, raising leverage while the base weakened. Ratings held in many places, but outlook language started to include exposure to physical risks and uncertain insurance markets. Your screen is simple. Pull hazard disclosures in the latest official statements: coastal surge, riverine flood, wildfire, extreme heat. Look for climate-adjusted reserves and named projects with schedules and identified matches. Check whether adaptation is front-loaded or punted to out years. Analysts expect adaptation to require materially higher capex and could plausibly double Muni issuance by the mid-2030s. So unfunded wish lists are a tell. Read whether the issuer has authority to raise rates quickly. Revenue bonds for essential services with proven coverage, at least about 1.5x through stress, and political room to move fare better than general funds under caps. Then layer insurance dynamics. Are major carriers retreating? Are state backstops solvent and priced to risk? If households can't insure at reasonable rates, your property tax base, assessed values and turnover, is at risk. If businesses face frequent closures from heat or smoke, sales taxes wobble. If flood maps are outdated, ask what happens when they're revised. Finally, separate adaptation funded by debt from denial funded by hope. Debt plus a credible plan, reserves, and pricing power is workable. Debt without a plan is a warning. Geography clusters risk, your portfolio shouldn't. Demographic decay, shrinking tax base, rising fixed costs. While climate redraws risk maps, people flows rewrite ledgers. Demographics decide who pays, how elastic that payment is, and whether fixed promises get lighter or heavier relative to the base. When wage earners leave or age out, costs don't politely follow. They stick and sometimes rise. Here are the stakes. Outmigration drags sales taxes and income-related revenues. Property tax depends on assessed value and transactions. Both soften when young families stop bidding. Aging populations shift spending and raise service intensity. EMS, public health, senior transit, without expanding the tax base. Pensions and retiree healthcare don't shrink on cue. Actuarially determined contributions keep stepping up even as covered payroll flattens. You get a structural squeeze, fewer shoulders, heavier loads. Action starts in a post-industrial county, already losing employers to automation and relocations. Young workers follow jobs across state lines. Enrollment falls, but not fast enough to let the district close schools without blowback. Appeals succeed on half-empty office buildings. Residential turnover slows as mortgage rates pin owners in place. Sales tax receipts flatten. The pension contribution rate rises as a share of payroll because payroll isn't growing. The county caps hiring, trims routes, and leans on fees that fly under state levy limits. Ratings analysts flag, narrowing revenue flexibility amid demographic headwinds. The phrase sounds clinical. It's a warning. Unknown to council members across town, the region's anchor hospital shrinks inpatient beds and expands suburban clinics. Downtown lunch crowds thin, parking revenue misses, and a tax increment district underperforms. The city backfills debt service from the general fund. The pension bill doesn't care, it's due. A quiet outflow becomes a budget story, then a credit story. Impact lands in layers. Houses age without reinvestment. Assessment growth trails inflation, which means real capacity erodes even if nominal numbers inch up. Streetlights fail in pockets, curbs crumble. Private capital prices that decay. Mortgage credit tightens, turnover slows, and comps stall. Councils push temporary levies for public safety and raise base utility charges to protect revenue bond coverage. Residents feel the squeeze monthly. Investors see spreads drift wider. Both are right. Here's a micro story. The school board meets on a Wednesday night. Enrollment is down again. The finance director proposes consolidating 2 underutilized buildings next fall. Parents object. The board delays again. The district keeps paying for heat, buses, and staff for empty seats. The GO rating stays investment grade, but the outlook slides to negative on structural imbalance risk. By Friday, the district's refunding guidance is 40 basis points wider. The tax bill will cover the difference. While that unfolds, a bedroom suburb that boomed during remote work stalls. Sales volume collapses as owners sit on low-rate mortgages and new families can't clear affordability. School rolls surprise to the downside. Fixed admin costs don't flex. The town's main lever is property tax, but a state levy cap limits increases. Leaders push a referendum to exceed limits for operations. It passes barely. Investors applaud willingness but note a thin margin, a sign future hikes will be harder. The reserve policy looks fine. The replacement cycle for roads and pipes still looms. Slower growth meets rising wear. University towns show the nuance. A flagship campus stabilizes demand, but if enrollment plateaus or international students dip, auxiliary revenues soften. Town-gown agreements determine who pays for police and fire. If the university's property is largely tax-exempt, the base skews to rentals with cap rate volatility. A strong pilot agreement buffers. A weak one shifts costs to homeowners. Investors price the difference in basis points. Contrast with a diversified metro pulling in migrants. Assessed values grow, incomes rise, dependency ratios improve. Pension contributions shrink as a share of revenue, not because promises changed, but because the denominator grew. Essential service revenue bonds shine here. Expanding payer bases, true rate-setting autonomy, coverage consistently at or above about 1.5x through stress. Demographics can be a credit shield if you own the right cash flows. What nobody priced early enough. Immigration offset domestic outflows for a time, then cooled. Regions counting on persistent inflows hit a stall. Rents loosen, permits fall, construction-related fees dry up. County hospital districts see uncompensated care climb as populations age and insurance costs rise. Their levies carry more weight. Outlook language adds rising fixed costs amid slower base growth. It's the same math again. Your screen is straightforward. Pull 5 and 10-year population trend lines. Avoid single-year noise. Break by age cohorts. The over 6'5" share rising without a matching increase in working-age residents means lower elasticity. Track dependency ratios. More non-workers per worker narrows capacity. Check assessed value growth versus inflation. Sub-inflation growth erodes real room. Read state tax and levy limits. Hard caps choke. Flexibility when you need it. For school districts, monitor facility utilization. Empty seats are an unfunded liability with buses attached. Then tie it to pensions and OPEB. If the contribution rate is rising against flat payroll, that math rolls directly into the general fund. Look for employers paying 100% of the ADC and adopting lower discount rates and closed, shorter amortization schedules. Those behaviors counter demographic drag. Wishful assumptions amplify it. Finally, map economic concentration. One dominant employer or sector, refining, paper, a single hospital system, raises correlation risk. A layoff or policy shift can hit assessed values, sales taxes, and utility loads at once. Places with healthcare, higher ed, logistics, tech services, and government anchors absorb shocks better. Bedroom communities reliant on commuters and homeowners with little commercial base are stable until they're not. When transactions freeze, their main lever is the rate you pay. Demographics won't default a bond next quarter. They will decide who pays, how quickly, and at what political cost. Own issuers where the math of people supports the math of promises, or size the risk like you'll be the one plugging the hole. Fund-level trapdoors, concentration, style drift, and yield chasing. Funds promise simplicity, diversification, daily liquidity, and professional credit work. The trap is what those words hide when markets move. You don't own a ladder, you own a manager's habits. In stress, those habits write your outcome. Start with concentration. A national fund can quietly stack 20% to 35% in one state because issuance is lumpy and big states dominate supply. Layer sector tilts, hospitals, senior living, land-secured deals, and your risk rhymes across issuers that share the same payer mix, labor pressure, or housing cycle. That's why a single state's legal change or climate shock can ripple through a fund that looked diversified on a pie chart. Now style drift. Mandates say intermediate and investment grade. The holdings file says longer calls, more BBBs, and unrated specials that pay a little extra. It's subtle. One new deal adds 10 basis points of yield, then another. Over a year, duration stretches, call exposure climbs, and the credit mix slides downscale. In calm markets, nobody cares. When rates jump or spreads widen, extension risk bites, and the intermediate fund behaves like a long fund at the worst time. Yield chasing is the accelerant. Managers compete on distribution rates, so they add premium callables, venture into thinly traded names, or lean on high-yield sleeves inside an otherwise IG wrapper. It works until it doesn't. In rising rate regimes, calls don't get exercised, maturities extend, and mark-to-market losses overshoot what the fact sheet implied. In outflow waves, funds sell their most liquid bonds first, the good stuff, leaving a weaker portfolio for those who stay. Liquidity mismatch is the quiet killer. Daily liquidity funds own bonds that take days to move at fair prices when the tape is thin. If redemptions surge, managers use cash, then sell liquid paper, then tap lines of credit, and in some cases redeem in kind. NAVs look stable until the high-quality cushion is gone. Performance lags peers, prompting more redemptions. It's a feedback loop that has nothing to do with your horizon and everything to do with other people's panic. Hidden leverage shows up in tender option bonds and derivatives. TB programs borrow short to buy long munis, boosting yield in good times and forcing unwinds in volatility. Prospectuses disclose it, fact sheets don't headline it. When rates move fast or credit gapes, deleveraging turns a drawdown into a skid. You didn't sign up for leverage, you owned it anyway through structure. Insurance wrappers can lull you. An insured CUSIP sounds safe until the insurer reprices climate or litigation risk across its book. If confidence fades in the wrapper, the market looks through to the underlying credit. Funds that never underwrote the obligor are now passengers. The wrapper buys time, not immunity. Fees matter more than marketing suggests. In low-yield worlds, a 60 to 80 basis point expense ratio eats a big chunk of after-tax income. To defend a headline yield net of fees, some managers creep down the quality curve or out the curve. The drawdown you feel later was born in the fee line today. So what do you check? Pull the full holdings file. Every line, not just the top 10. Add up state weights. Cap any one state, especially where you live. Tally sector exposure. Hospitals, senior living, land secured, tobacco, transit. Compare average duration to the stated benchmark and mandate. A big gap is drift. Flag callable share and next call clusters. Bunching means extension risk on one date. Count BBB and below. Look for unrated buckets. Search the statement of additional information for TOBs, derivatives, and redemption in-kind policies. Then stress test behavior. How did the fund do in the 2013 taper tantrum, March 2002, and the last rate spike? Did they raise cash before outflows, or chase yield into the sell-off? Did duration stay within band, or creep? Did BBB exposure jump in a quarter? Pattern beats pitch. Microstory. A popular high-yield muni fund runs 12% in one state, wrestling with levy caps and wildfire risk. It layers hospital credits at thin margins and a sleeve of land-secured paper. When insurance premiums jump and a regional system posts weak results, spreads widen across the sleeve. Outflows start. The fund sells its AA water and sewer to meet cash, leaving more of the BBB sleeve behind. Distribution holds for a quarter, then gets cut. The NAV never bounced the way you expected because the good collateral left first. Practical fixes are boring and effective. If you need funds, pick national, high-quality mandates with explicit caps on state weights and BBB exposure, tight duration bands, and minimal TOB usage. Favor managers who publish full holdings monthly, show stress histories, and keep dry powder into volatility. Low fees buy you patience. If you can build separately, run a ladder of essential service revenue bonds with clean calls and verified coverage. Either way, don't rent yield you can't underwrite. The taxpayer contagion. How downgrades hit your wallet. A downgrade starts as a sentence in a ratings note and ends as a line on your bill. The stakes are immediate. One notch lower means higher coupons on every new school, road, and water project. That extra interest isn't theoretical. It's collected in mill rates, base utility charges, sales taxes, and temporary levies that quietly renew. If you own the bonds where you live, you take the hit twice. Your portfolio marks down as spreads widen, and your household cash flow tightens as the city closes the gap. Here's how it unfolds. Analysts flag rising fixed costs and limited revenue flexibility, and shift the outlook to negative. Underwriters widen price talk on a refunding that used to pencil savings. The city pushes ahead. Maturities don't move because hopes did. The deal clears at a higher coupon. That locks a decade of extra interest into next year's budget. Spreads drift wider in the secondary, so your CUSIPs mark lower before any payment is missed. You haven't lost a coupon, but your total return just turned red. Budget triage starts the next week. Finance staff draft mid-year fixes. A modest mill rate bump, a water base charge increase to protect coverage, a renewal of last year's temporary public safety levy. Departments freeze hiring. Library hours shrink. Paving contracts get deferred a season. Residents feel it in slow, granular ways. Longer 911 hold times, fewer bus runs, more potholes, and in one big way when the bill arrives. Now the loop closes. Services slip while costs rise. Property owners appeal assessments. Some businesses shelve expansions. Assessed value growth trails inflation. With less real base, the next bond sale prices even wider. The city pays more to borrow as it collects less. The ratings language hardens. Pressure on revenue performance, elevated fixed costs, and the negative outlook lingers. The market doesn't wait. Benchmarks move. Funds trim exposure to stay within quality bands, selling what trades and leaving weaker paper behind. Microstory. Monday morning, the school CFO opens refunding results. The savings the board presented last month evaporated in the concession. By Wednesday, the superintendent extends a hiring freeze and postpones a curriculum buy. Friday, your property tax notice lands with a line item tagged Debt Service Stabilization. The district's rating letter didn't change, but your payment did. Meanwhile, essential service systems must defend covenants. The Water Authority's chemicals and energy are up, and capital is front-loaded after a winter of breaks. To keep debt service coverage above 1.5x, the board passes a base charge increase that doesn't count against state levy caps. It reads small, $5 to $8 a month, but it stacks with city fees and county assessments. Revenue bonds look stable because they can raise rates. The payer is you. State policy sets the ceiling. Levy limits and assessment caps constrict how fast property taxes can rise, even when fixed costs surge. Councils pivot to fees, fines, and special assessments that skirt caps. Ratings shops call this willingness and ability to raise revenues. Ability is throttled. Willingness shifts to regressive tools. Investors see stability in coverage and reserves. Households see shrinkflation in services plus a higher monthly nut. Insurance stress magnifies it. Premiums jump in hazard corridors. Some carriers exit. Disposable income shrinks. Sales tax softens. Housing turnover slows. Appeals rise. Assessed values flatten at the margin. The same pension dollar and higher debt carry now consume more of a weaker base. Issuers borrow to bridge timing gaps, adding leverage in the very moment the base sags. The negative outlook persists. Your Muni fund trims higher quality names to meet outflows, and the NAV recovery you expected takes longer. If you live where you invest, keep it small. Cap home state exposure. Prefer essential service revenue credits with real rate-setting autonomy and proven coverage over general funds boxed in by caps. Watch outlooks like smoke alarms. A negative outlook is a price signal, not just a label. And remember the sequence. Language changes, pricing widens, budgets triage, taxpayers pay, long before any default talks begin.